Cryptocurrency markets operate in a state of permanent execution, with 24/7 liquidity and zero regulatory circuit breakers, subjecting capital to constant, unprotected friction. Unlike traditional equities, returns here exhibit high kurtosis. This means the distribution has fat tails, where extreme, portfolio-crushing price events occur with statistical frequency. These charts display the macro price development of four major crypto assets across multiple years. Notice the extreme verticality of the 2017 and 2021 bull runs, immediately followed by drawdowns exceeding 80%. To navigate these volatile swings, retail traders typically rely on technical momentum indicators, like the Relative Strength Index or MACD, to map out entry and exit rules. The problem is that these indicators generate divergence traps. A trader sees a technical signal suggesting a reversal and commits capital, but the reversal never materializes. The trend continues, and the position is liquidated. This creates a structural conflict. Simple, fixed-rule indicators are attempting to capture consistent alpha in an environment that is violently nonlinear. The failure of these traditional models does not stem from a lack of historical data. The failure is a lack of mathematical adaptability. To survive a fat-tailed market, the trading architecture itself must learn and adjust. To understand why adaptability matters, look at how a standard momentum strategy actually functions, specifically the exponential moving average or EMA crossover. The math is straightforward. The algorithm subtracts a long-term exponential moving average from a short-term one to isolate the immediate trend. If the resulting value is positive, the system generates a +1 signal to go long. If it's negative, it outputs a -1 signal to sell short. The core problem is the smoothing mechanism itself. By averaging past data, the EMA creates a physical time delay between the live price action and the signal generation. This graph illustrates that exact mechanical failure during a sharp market correction. The raw price, plotted in blue, collapses sharply in the top panel, but the short and long EMA lines take significant time to actually cross over and register the drop. Because of that time gap, the trading model remains in a long position while the actual asset price plummets, wiping out accumulated gains before the algorithm recognizes the crash. By the time the short signal finally triggers, the market has already reached a local bottom, forcing the system to sell low. Lagging indicators require time to calculate momentum. In assets that drop faster than an indicator's smoothing window, these strategies are structurally incapable of preserving capital. The quantitative alternative to lagging indicators is direct reinforcement learning, a machine learning framework designed specifically for algorithmic trading. Most financial models attempt to forecast the future price of an asset, which is notoriously difficult. The DRL thesis takes a different path. It assumes it is easier to calculate the optimal market position than to predict the exact future price. The system operates on a decision function, mapping a sequence of recent hourly returns directly into a binary output of -1 or +1. The core of this function is the parameter vector, theta. This acts as the brain of the model, assigning specific mathematical weights to the importance of each past return. It processes an information set representing a defined look-back window of those past hourly returns, determining which patterns demand immediate action. To train this brain, we need a utility function. This is the explicit mathematical target the algorithm will constantly attempt to maximize as it reviews historical data. Optimizing purely for total returns often results in reckless, high-risk behavior. Instead, the model optimizes for a Sharpe or Sortino ratio, forcing the algorithm to maximize returns while strictly penalizing downside volatility. We also introduce a transaction cost parameter, delta. By forcing the algorithm to factor in the real-world cost of trading fees, it stops the model from switching positions based on low-probability market noise. By mapping raw returns straight to a weighted position matrix and factoring in fees, DRL removes the middleman of price prediction and focuses entirely on risk-adjusted performance. For this architecture to work, the algorithm has to actually learn the correct values for theta through an intensive training phase. It does this by using gradient ascent. The model takes a set of parameters, tests them, calculates the slope of the utility function, and climbs mathematically toward a higher, more profitable value. But there is a mathematical obstacle. Calculating a gradient requires a smooth, differentiable function. Actual trading signals operate on a sine function, rigid, absolute steps between long and short positions that break the calculus needed for training. Here is the solution. During training, the discontinuous step of the sine function on the left is replaced by the smooth S-curve of the tan function on the right. Because this curve is continuous, the model calculates exact gradients to increase its utility score. The algorithm enters a loop of epochs. It runs through thousands of iterations over the data, making slight adjustments to its theta weights with every single pass. The size of these adjustments is controlled by the learning rate, or eta. If the learning rate is too high, the model overshoots the optimal peak. If it's too low, the model runs out of time before ever reaching it. To ensure the algorithm is finding real patterns rather than just memorizing historical data, researchers use a strict validation strategy, splitting the data into a training set for learning and a hidden validation set for testing. Replacing binary trade signals with differentiable curves is what allows the machine to mathematically solve the market's historical patterns. Once the training is complete, the true test is out-of-sample performance. How does a trained DRL model actually trade in a live simulated unseen crypto market? Across Bitcoin, Ethereum, Litecoin, and NEO, the results are clear. The DRL model registers higher Sharpe ratios and lower maximum drawdowns compared to baseline buy and hold and standard momentum indicators. By continuously calculating optimal positions, the static DRL consistently outperforms momentum strategies in risk-adjusted returns. But capturing this alpha requires a mechanical trade-off. The DRL model executes a significantly higher volume of trades than a standard exponential moving average. The dense clustering of red and green arrows shows the model rapidly switching positions, driving the aggressive upward climb of cumulative returns. While an EMA algorithm sits frozen, the machine learning architecture instantly shorts the market, preserving its balance. This hyperactivity makes the algorithm highly sensitive to friction. If transaction costs on the exchange increase even slightly, the cost of flipping positions devours the generated alpha, rendering the strategy useless. Provided the execution environment features low fees, the machine learning architecture discovers a faster, more responsive regime of trading that technically outpaces traditional momentum. If training on historical data yields good results, it seems logical that an online learning model, one that continuously updates its parameters at every single time step, would perform even better. Instead, researchers encounter the online learning paradox. Models that continuously update their parameters in real time consistently perform worse than static, batch-trained models. The structural failure occurs because the online model lacks a static validation set. Without a buffer, the algorithm begins hyper-optimizing itself to the random noise of the most recent price window. As it aggressively tries to capture every minor fluctuation, the parameter vector begins to drift, stretching into extreme, uncalibrated values. This parameter drift corrupts the decision function. The trading signals become erratic, switching positions on microscopic, unprofitable price movements and generating heavy transaction losses. By contrast, the static DRL model uses a 1,000-hour validation buffer to lock its parameters in place, ensuring logic remains stable through live execution chaos. It proves a counterintuitive reality of algorithmic system design. Feeding a model more data and allowing it to constantly update does not yield higher returns. Rigorous constraints on the machine's learning process provide a greater competitive edge than the raw complexity of the algorithm itself.